Quick conversation right now about stay-at-home stocks. They had a big recovery on Friday after news of a new variant possibly affecting the United States. Zoom, DocuSign, Netflix, and Peloton all gaining some traction. Joining us right now is Gene Munster, Loop founder and managing partner. Good morning to you, Gene. Lots of folks trying to understand what these markets mean in light of this new variant. And it increasingly seems that a lot of investors are saying to themselves that they actually think that they should look past this. But those that are trying to look past it in certain ways don't seem to be look pasting some of these stay-at-home stocks. So I'm curious whether you think that a Peloton is worth it at these prices or Zoom is worth it at these prices.
Andrew, the simple takeaway is you can't look at all stay-at-home stocks equally, and pattern recognition from the past, the surge that they have had, doesn't necessarily mean they'll continue to surge. And before I answer your question, I want to remind people over the last month, both Zoom and Peloton, those stocks blew up as we return to normal. But to answer your question is between Zoom and Peloton, I would take Zoom over Peloton. The reason is that some things are not going to change, and that hybrid work environment piece will be with us despite any sort of variance. And that obviously benefits something like Zoom and DocuSign. Peloton, on the other hand, has quite an incredible product. It has retention rates that would probably flatter any drug dealer. And at the end of the day is that those 92% retention rates don't change the reality that people are lazy. They would rather be on TikTok than invest in working out. And we saw that in the September quarter results. They lowered the price. It did not yield the uptick in new users that I would have anticipated. And I think when you put that together, it is a reminder that Peloton, great product, but I don't think that this is a long-term winner from the pandemic, but I do think Zoom and DocuSign are.
But then you see stocks like Netflix move higher. By the way, you haven't seen AMC or some of the theater chains get as hurt as you might imagine, given what's happened. How do you think about those two?
So Netflix is obviously has some benefit here, but at the end of the day, this is a hit-driven business. Content is hit-driven, and Netflix has done an incredible job of playing, continuing to drive their title releases. And you see it, their stock is just off of all-time highs of the stay-at-home. It's only down 4%. The other, if you look at Peloton and Zoom, they're down 60, 70% from their highs. And so to answer your question, I think the fabric that is running through the whole conversation is that the variant is, I think investors generally anticipate that this will not cause, as it stands today, will not cause further lockdowns in the U.S. That's why you don't see some of those other entertainment stocks hit as much. And you don't see Netflix having that same lift. Again, I would put Netflix, understand why it participates in a day like Friday, but I think that it should be judiciously put off to the side and thought of a very competitive, hit-driven business versus a stay-at-home company.
Shepard Smith here. Thanks for watching CNBC on YouTube.